Hello everyone, I'm Bede of Investment Advisory Group for First Metro Investments. I'm here to basically give you an overview of how things are for the fund, for the SALEF and the equity fund for First Metro performance, and our view and how we think and how we perceive its performance and how its outlook, of course. So let me start with our this heading that we have here right now. It's our turn. The Philippines, it's our turn, and let me explain to you why we think and why we believe that it's a Philippines turn. Okay. Let me start with a brief summary of our outlook and strategy for how we will manage the fund in moving forward. We believe that the fund will continue to perform well, not only in the coming quarters, but I think in the coming periods, moving forward, even next year. And why do we think that? Basically, the Philippines carries a strong domestic fundamental. We are intact in terms of our numbers. Our inflation is expected to be within low digits, probably within the under 4%. Our interest rates will remain low. Corporate earnings, we maintain our projection of our corporate earnings at 19% to 20%. And of course, we have the possibility of a credit rating upgrade the second half of 2012. Other thing is we are expecting the continuation of the public-private partnership program implemented moving forwards, I think third and fourth quarter of this year, and that should be able to provide us and the economy boost its expenses, and in terms of job growth, in terms of expenditures, and of course the other factor that we are confident is the softening of oil prices. As we all know that it's low oil prices is inflation friendly and definitely is a growth enhancer. Okay, and if you going back to some of the data that came out last week or 2 weeks ago, we posted the highest GDP growth at 6.4%. That's only second to China, and the strongest in Asia. And that's without government spending. So now we believe that in the coming quarters, third quarter, with the government spending, we believe that the growth will be sustained. Consumption spending will be high, and we have, of course, if you see some numbers, 2 days ago, we have the car sales was up 31%. That's quite rare for a sales in auto sales. Okay, now these are the three areas that we see kind of like a game changer for us, and that would direct the performance of our economy. Europe, of course, we expect a 25 to 75%. This is the consensus of a Greek exit within 18 months. Although as we speak, there seems to be a consensus that Greece will be voted to remain in the Eurozone. Again, anything can happen, but so far, as we speak, the sentiment is moving towards staying in the Eurozone. Now, China has been always a concern. Among the concerns that we believe China can contain and can sustain its growth and its economic growth. They have cut its interest rate about a few days ago. They have lowered it, and that is a sign of it attests that China is willing to boost its economy. U.S., we think there's a minimal risk of recession in the U.S., and we believe that numbers are showing up basically as far as in terms of growth. Okay, now let's look at this chart. Let's focus on this chart. It's a PSI. As you know, we maintain our target of 5,500 year end. Again, few quarters ago, 2 quarters ago, end of last year, we projected a 5,000 year end, but again, it was achieved in the first quarter of this year. Now, of course, we would like to remain at 5,500. This is about 10% from where we are right now, and we think it will be achieved. We believe it will be achieved by the end of the year. Let's look at our top 10 holdings. Again, it's quite diversified. We have a nickel company. We have, of course, GT Capital. We have a property. We are into construction infrastructure. We have banks, telecommunication, again, infrastructure. And of course, we have into retail and consumer conglomerate. Again, these are just the top 10. And these issues are issues that well researched, and we believe it will benefit. It will be a beneficiary of the economic upswing. Okay. This is the chart of the index and the foreign buying. As you can see, the drop is there's a drop here. This is when the big sell-off. But then moving forward, we continue to see some net foreign buying. It hasn't actually dried up, so it just shows that foreign funds continue to get attracted in our market. Of course, we maintain our PE to be at around currently we're at about 15 times, but that is from the historic high of about 18 times. When we see the upside of 5,500 because of the 20% earnings growth, we should see the PE actually for next year to even be to stay around 15 to 16 times. Okay, here are indicators. We are looking at, of course, the index at 5,500, profit growth of about 19 to 20%, PE about 14.3 times, economy, well, of course, at about 6%, inflation at 3.5 to 4.5, and interest rates at 5.5%. Okay, okay. These are game changers for the local market. If you can see the SDA and inflation level, inflation continues to trend down, okay, but SDA levels continue to be just stable. But we feel that we believe that moving forward, this level of inflation will continue to be reduced, and we are hoping that it will find its way to the equities market. Okay. All right. These are stock picks, of course, other than the top 10 we have. Okay. Now, right now, based on those numbers, based on those figures, and based on the chart that I've shown you in the index, your fund basically is well diversified at this point, and we believe that by the end of the year, between the end of the year, we are confident of an outperformance. We are looking to add another 15 to 20% between now and end of the year, coming from current levels. If the index makes about 10%, probably we can easily beat that. The portfolio that we are right now are quite geared towards that outperformance. Okay. Okay. So as we move on, as we move to the third quarter of this year, we continue to realign the portfolio into mainly the MSCI and blended with the PSE index. We are not just focusing on the composition of the PSE, but also blending what we call the Morgan Stanley index, which is quietly watched by the foreign funds. And if you look at our stock picks right now, it's quite diversified other than the top 10. And they're all focused on our theme: infrastructure and construction, consumer, and we have some gaming, and we have some property and banking, and of course power and energy. Now, all these issues are not only dividend-paying stocks, but at this point, they maintain an average PE below the market. Okay, so if the index right now is doing around 15 times, if you really average this, the only high PE right now we're maintaining is Ayala Land and Pure Gold. But let me tell you why those are high PE. These are consumer issues. These are consumer stocks, and they are always, even from historically, they always maintain high price to earnings ratio. And consumption here in the Philippines is one of our biggest bet. It's in line with our tourism growth. We continue to be positive on tourism. That's why we also like gaming stocks. That is in relation to tourism, growth in tourism and consumption. And let me go back to the figure of 6.4% GDP. That's without government spending, and it was reported as strong consumption spending. That means the domestic economy has enough firepower to keep the economy afloat because of consumption. Of course, that with the help of remittances, with the help of what the business process outsourcing, dollar earnings, and of course new money coming into the market and investments coming into the market. That's all blended into what we call strong domestic growth. So let me finish by saying that your fund, we believe and we are confident that your fund will continue to outperform the market, the benchmark, in the coming quarters. And if the market, like I mentioned, if the market can turn about 10% between now and year end, we're confident the fund will most likely do better than the 10% index.